I'm going to say this without a stutter. You will not meet a more selfless individual in your entire life.
One of the things that is super important about this profession is communication.
I think financial planning fees are going to moon, if you will.
I look at running a marathon very similar to a person's 401k.
For any of those aspiring advisors out there, where you are may not be where you end up, and that's perfectly okay.
I love that.
Welcome to the inaugural episode of Q&A. I am your host, Tyrone Ross. In this episode, you will see my conversation with Mark Martiak, wealth strategist for Alliance Global Partners. In this episode, we cover a timely topic that you all will be familiar with and have an opinion on, inflation, of course. Enjoy, and we'll see you on the next one. All right, Mark, welcome to Q&A. You are our first guest on the inaugural episode of Q&A. How are you today?
Thank you, Tyrone. I'm great. I'm doing well, thank you. And I'm excited to be a part of your new program.
Yeah.
And I'm looking forward to our exchange.
Well, thank you for dressing
welcome.
up for the job interview. Appreciate it.
Thank you.
So let's dig right in.
Yes.
Tell everyone what you do. Obviously, this is a show that is for advisors by advisors. You've been at this a long time. So talk to everyone about what it is that you do.
Sure. I manage money for private clients,
Okay.
typically high net worth individuals and ultra high net worth individuals. And I create financial plans for them. So I take a holistic approach. I'm a wealth strategist at Alliance Global Partners here in New York.
Yep.
And I've been doing it for 19 years now.
Right. So let's dig in a little bit before we get into your question, right? And your question is very timely, especially on the data we're actually shooting. But wealth strategists, right? We'll have a bunch of folks watching this that don't really know what that is, right?
Yes.
And I think part of this show is we want to make this more inclusive, if you will, to more people to pull them into financial services. So what is this wealth strategist exactly, and what do they do?
We help clients develop a financial goal and or set of goals. So I take a holistic approach, and it begins very simply with understanding what my clients' goals are in their financial life.
Right.
It continues with making a recommendation
Okay.
for an investment strategy.
Okay.
And for many clients, their investment goals include, will I have enough money when I decide to finally retire?
Right.
Or do I have any blind spots that need to be covered?
Okay.
So that four-step approach includes uncovering and understanding those needs and defining those financial goals.
Right.
It continues with making a recommendation for an investment strategy, then implementing that strategy, and then checking in and constantly reviewing how that investment strategy is doing in my client's portfolio.
Right. Okay. So very much a holistic financial plan, if you will.
Exactly.
Right. And then included in inheritance and estate planning and the
Yes, yeah. I mean, there are three phases in one's financial life: wealth accumulation,
Yes.
wealth preservation,
Yes.
and then wealth transfer.
Right.
So for many people, that accumulation phase takes a good part of their working life. And then they have to preserve it. So, and very often it's preservation occurs closer to the retirement age.
Yeah.
And then transferring it simply means leaving a legacy for your loved ones.
Oh, I love that word, legacy. Yes.
Yes.
And hopefully this show gets folks closer to wealth accumulation. Right? Everyone's dream to accumulate wealth. So let's dig into your question, right?
Yes.
So we are in a time now that is very turbulent. The macro environment is very challenging. And thank you for submitting your question. So I will let you ask the question, and I will give my two Satoshis. Get used to that term, people, on what I think. But obviously we'll have a dialogue about it because I think it's important to get various opinions and perspectives. But shoot your question, and then we will open it up to our dialogue, if you will.
Yes. Well, we're in a rate tightening cycle right now, as you know, Tyrone.
Right.
And I'm wondering what you think about the Federal Reserve, our central bank here, in terms of how long, how much higher will they raise the rate, the Fed funds rate, which is the rate that banks use with each other when they're making overnight loans.
Yep.
How much longer will the Fed raise the rate? So how much longer and how much higher?
Right.
That's my question to you.
Well, it's funny. I consider myself an expert on this because I've been listening to macro Twitter spaces. I kid, but I think first thing I'll admit, no one knows. But I do think we know they are going to continue to raise rates, in my opinion, right? I think you look at the job market, very strong. He's hearing the hawkish overturns that from all the Fed chair members. So I think we have a ways to go here. Today, on a day where we'll be getting some new numbers and perspectives on what is happening, I think one of the things we need to do is brace for longer, inflation, higher inflation, and them raising rates again, probably another quarter and a half percent. So I don't think this is going to stop anytime soon. But again, not the macro expert. So I think, as you know, we are preparing clients for that, a rising rate environment, which is to say, this is an environment that a lot of investors coming into markets for the first time haven't experienced, right? High inflation and then rising rates, and we can get into mortgages and what the 10-year is looking like right now, and folks that are new to investing. But I think there's a ways to go here. I don't think the Fed is going to let off the gas pedal, mainly because they have to correct, the desert policy for the last couple of years. But what do you think?
I think you're right. I agree with you. I think you summed it up really well. I have been sharing with clients that the new IRR is not internal rate of return on your investment portfolio. It's inflation, rates, and recession.
Oh, I like that.
So the idea here is that because the Federal Reserve may have taken longer than they should have to begin the cycle of rate tightening, they are now playing catch up. So during their last 3 FOMC meetings, Federal Open Market Committee meetings, they raised that rate 75 basis points each time. And the only time they took a break was when they didn't have a meeting, and that was, and it was pretty much, again, brought up at a Jackson Hole, Wyoming meeting in August among the central bankers, when Chair Powell mentioned that there will be pain. So I think, as you mentioned earlier, this morning the latest inflation reading came out, headline inflation, and it came in for September at 8.2%. Down 0.1% from 8.3 in August. So the Fed now is scheduled to meet again in November, during the first few days of November, and then during the third week or so in December. So I anticipate that they will raise the rate again. And some are saying 75 basis points for a fourth time. Others are saying 50 basis points. And then when December comes, the forecast also by a lot of asset managers and economists are suggesting that they might raise it if it's either 50 or 25. So it could be 75 and 50, it could be 50 and 25, but it's anyone's guess.
It's anyone's guess, and I think that's the one thing that we need to understand here. A lot of what happens in the market, especially globally, is out of our control as advisors, right? But what we do control is the psychology of the client and walking their hands through this. What I've seen is, again, they'll do 75 and then 50 next. But everyone has seen and felt and heard something different, right? I always joke that Powell is sitting somewhere with a nice cold beverage, laughing at everybody trying to figure out what it is that he's going to do. If I can ask you this favor, to put this in context, right? You hear, I always talk about, and we always talk about in this industry, of making things similar and tangible to people, right? Through similarities and metaphors, if you will. Almost to get folks to understand things in context. So those that are experiencing this for the first time, you always hear about the raging inflation in the 70s, right? Kind of put that in perspective here, where you see folks on social media and everyone saying, well, rates used to be 12%, right? For buying a home, and now everyone's bugging out because it's 6%, right? So kind of put that in perspective for people and what you're saying to clients in terms of relating what we have now to time periods before.
So I think that clearly we have low unemployment right now. And it's
3.5%, I believe, something like that.
About that, right? That's right. And I think that's a good macroeconomic condition. I don't know the exact data point or what the unemployment rate was back in the 70s, but I was around. And what I thought was really interesting about then versus now was there was a time where inflation was out of control. It was higher than it is now, much higher than it is now. And the Fed chair at the time, Paul Volcker, I believe, had to really tighten up, the Fed policy for rates. So, and I also recall folks, including me as a young, newly licensed driver, having to wait in line on alternate days for gas based on your license plate number. Now, I don't see that happening today. The prices of energy are starting to come down. Gasoline, certainly on a national pricing level, has started to fall since about midsummer. I think you would agree with me. So you can contrast higher inflation in both periods, but I really think it's different now because of what we've learned from the past, and I don't think it's as severe with energy. Now, what I do see as a challenge is housing. And rental. So for your audience, perhaps, or for borrowers that want to finance their first-time home purchase. I think housing cost and shelter, I don't see that cooling off anytime soon. And in fact, I see more. We don't even meet the housing supply if you listen to the home builders. That are out there. We don't even meet the housing supply with the supply that we need to meet the demand.
Well, it's funny. That's another area of contentious debate of what's going to happen with housing. But you look at the rates, right? Close to 6% now. A year ago, 2 and some change.
The double.
Right? The monthly payment going somewhere between $1,200 to now $2,300. If I am a millennial or someone at first time, home buyer, that's a really tough environment.
It is.
And I think what we do, again, as advisors, kind of create this framework for clients to walk into, right, and hand them some advice, but also guidance on after you do this, right, context, because you don't get to buy a house in the 70s or the 80s. You're buying a house now, right? And what does that mean in terms of your long-term goals, right, and ultimately the environment that you're in? So I think housing, employment, right, the equity markets, right, and just markets in general. And you look at what's going on globally. Central banks around the world are trying to figure this whole thing out. But I think here, the Fed is basically saying, look, we're going to crush this, right? We have to compress it. And those of you that know what we do, and asset holders, the same group of you that benefited, right, when rates were low, we're going to compress those, those that hold assets now. So I think as those come into the market, first-time home buyers, those that are looking to sell. I have a friend now that's 6 months, right, a house been on the market, where if you go back a year ago, you were folks that list their house 6 weeks later, or 6 hours later in some cases. They had buyers. So now it's really, really crickets at this moment. But
I agree.
I don't know if you have any further thoughts.
To your point, yes, sellers are having to wait longer. So, and that can create a lower valuation or a lower pricing of the housing market. The rent, that's another story. Because of the demand, I don't know that rental cost will come down as fast as housing prices that you're buying on the market. So you may see, as you just did.
Well, growing up in New Jersey and now living in California, those that live on the coast are numb to high rents. But now it's starting to pervade areas of the country where it was affordable. Right now it's less affordable. So
in between the coast.
I think this is something now, and again, for me as someone who constantly advocates for the underserved, folks who don't get access, inflation targets and inflation conversation excluding energy and food.
Core inflation.
Are you kidding me? Right? Like,
no, that's right.
These are the things that the everyday person have been feeling for a while now. Right? And in some cases they wish it was 8%. But I don't want to. We could talk about inflation forever. I don't want to lose the moment of having you here to discuss this. We have a growing base of advisors that are, I think the average age of a principal at an RIA is 62. Average age of an advisor in the mid-50s. Without a young group coming in. That's a conversation for a separate day. We'll have that again. But I do want to talk about the young advisors that are in right now, that are going to be watching this show, right? That have grown up hearing the brand Nasdaq and knowing what Nasdaq does, and everyone's dream is to come here and be a part of this scenery where we sit right now, which is special. But for a young advisor that is having to start a practice and grow a practice in this environment, like what would be your 2 Satoshis to them as they start to not only get into the business, but want to work with clients and help clients survive this environment? And this, you only grow your business by adding value, right? So how would a young advisor get started and add value to clients in this environment? And we spoke previously before this. I want to add a little bit. Add in your background to that answer as well, because you've had a really nice journey up until the point of sitting here. So
thank you.
That into it.
Well, you brought up a good point earlier. It's about networking. So if you're a young advisor in this environment, you should take every opportunity to network. Network with your college alums, your peers. Network in professional associations. Network at meetings that are in social environments.
Yeah.
So you need to be out there and be everywhere at the same time.
Yeah.
But you also have to focus on the segment that you want to focus on to grow your practice.
Yes.
For many, you're from Jersey like I am, but you're out on the West Coast. I've lived there. For many, that might be focusing on the entertainment segment.
Yep.
Talent agents, anyone in the movie business, actors, or athletes.
Yeah.
So have a market segment in mind.
Yep.
When I first started at Merrill Lynch, approximately...
Merrill Lynch myself.
Right. Exactly. That's right. We discussed that.
Yeah.
When I asked the manager to, in one of my earlier, like first, second week there at the firm, what does he think if he could summarize what he can prescribe for me to be successful as an advisor starting out, he didn't miss a beat. He told me, you have to force early success. And I've always kept that in the back of my mind, forcing early success. Now, that doesn't mean forcing your philosophy on a potential client or someone you want to have as a client. That just means that in the back of your mind, you have to always be gearing up for focusing on your success and building that success. I also think that the more accreditations that you can receive,
I'm just getting to that.
Right, you were at the CFP board, my understanding, yesterday in Washington.
Yeah. And
so having a CFP gives you credential. I'm an accredited investment fiduciary.
Yep.
That helps.
Yep.
CPWA, Certified Private Wealth Advisor. There are several credentials, CFP, as we said. So my path was as a second career professional.
Yeah.
So my earlier career, I sold advertising.
Yeah.
And at some point after the .com 1.0 bubble bust, I felt that I should come to this industry. This is a great industry. You make a very good point earlier about an older person. The average age is 62, I believe you said.
Yeah,
and
principal,
so a wave of young advisors have to come into the business, but it's incumbent upon individuals like you leading the way, individuals like me building out teams and mentoring whenever we can provide mentorship.
Succession planning, right? Is another big one that needs to be put into place. But I want to add this before we kind of, rush to a close here, is I think financial planning fees are going to moon, if you will, right? Yes. So I do think every young advisor should get the CFP.
Yes.
Right? It's literally your driver's license throughout our industry.
Yes.
And it's funny, you mentioned me being down at the CFP board. I was trying to explain to my mother, who has no idea what I do. But she's like, well, what is that? And I was like, well, it's kind of like the MD, right, of financial advising. So I think that right away gives you instant credibility.
It does.
I think also one of the things what we can't do is segment those like yourself that are doyens in the space, that have so much experience that can kind of walk you through starting a firm. And the last thing I'll say is this. If we want more diversity and inclusion and representation in the space, starting a new firm is hard.
It is.
And especially if it's AUM based, right, which I'm sure we'll have plenty of episodes here. So if you don't bring business with you, it is incredibly expensive to start a firm.
Agreed.
So I think focusing on niche when you're looking for it, niche when you find it. If you find your niche, and you start to work with the group that you have familiarities and similarities with, it's much easier for you to grow, and that means the longer you add value, the longer you stay in business. But I think you made some really good points there.
Thank you. Likewise, too.
Yeah, absolutely. So as we close here, I want to give you an opportunity to, again, promote yourself, talk about what you're doing, and give the audience any advice, Q and A is for advisors, on, again, what prompted you to submit your question and ultimately, agree to spend some time with me?
Well, the opportunity to be with you, because I followed up and heard about your background and what you were doing here with this programming, and I was hopeful to sit with you because I wanted to hear your insights and share my insights.
Yeah.
And I think that we've been able to accomplish that. So as an advisor, I work with clients depending on their stage in their life.
Yeah.
I don't have minimums for younger clients.
There you go.
So
Double fist pump.
right, and I think we discussed this earlier.
Yeah.
Because otherwise you set the bar too high for a younger client that's not quite there yet, but their future earnings are right in front of them.
Yeah.
So I think you have to look at the clients. I look at the clients as I want to listen to them, I want to help them achieve their goals, but I also, depending on their age group, will understand if I add value based on what they can start investing with.
Appreciate it.
So I'm available to help all clients. One of my colleagues who used to work for one of the fund companies used to say we're open 24/7.
There you go.
So you know how to reach us. So the same thing here. You
Well,
know how to reach me.
in that case, you could take on a lot of crypto clients. Mark, it's open 24/7, 365.
That's true, right?
All right, thank you all for tuning in to this inaugural episode of Q&A. We will see you on the next one. Mark, thank you for joining me.
Thanks,
Appreciate
Tyrone.
you.
It's been fun.